Ladies and gentlemen, good day and welcome to Senco Gold Limited Q1 FY2024 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star 10 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Alok Shah from Ambit Capital. Thank you, and over to you, sir.
Thank you, Zico. On behalf of Ambit Capital, I would like to welcome the management of Senco Gold and Diamonds for their 1Q FY24 result conference call hosted
There are more than 20 parties in the conference.
I would also like to thank all the participants who are joining the call. From the management of Senco, we have the senior management team led by Mr. Suvankar Sen, Managing Director and CEO, and Mr. Sanjay Banka, CFO. I will now hand the call to Mr. Suvankar Sen for his opening remarks, post which we can take the questions. Over to you, Suvankar, sir.
Thank you very much. Good evening, ladies and gentlemen, to the earnings call of Senco Gold Limited. Before we get into the performance of the company, we would like to talk a little bit about the industry, just to put ourselves in the right perspective. So the total jewelry industry is a 4.5 lakh crore on $58 billion size, out of which we can assume that 33 to 38% of the total industry size is for the organized player. And in the future, it is predicted that the industry size would move up to around $80 billion, and the share of the organized players will go up to 42 to 45%, closer to 50% over the years, maybe by FY26 or 27. And what is driving this movement of unorganized to organized is certain factors. Primarily, it is the hallmarking that has become mandatory, which is, we know, even with our performance, we can see that the preference of the consumer is moving more towards branded players following certain systems and processes. Also the fact that with GST, the various laws and rules, it is getting difficult for the unorganized players to work, and either they are shifting to the organized sector or organized players like us is having a kind of a tailwind to move ahead of the others. Also, there has been a preference for the consumer towards buying from brands. The design, the collection, it is no more a time of just selling a product or a category, but it is about selling stories. And it is with that perspective, I think brands are moving ahead of the unorganized sector. Now, very important overall, if we look at it in terms of the margins and the profitability of a jewelry company, we have seen that the stud ratio or the ratio of the share of diamond jewelry in the overall sales of the company is very, very important to ensure that the profit keeps increasing. And we have seen that the industry average has been around 15%. For Senco, in terms of the share of diamond jewelry in the overall sales, it has been in the range of 9 to 10%, and our endeavor has been moved towards 15%. But if we have seen, especially this quarter one, our share of diamond jewelry has been 11%. And in terms of quarter-on-quarter performance of diamond jewelry as the overall jewelry sales, we have seen a huge growth of 50% in terms of value and around 34% in terms of volume of diamond jewelry. We are all aware that the IPO has been a great success for Senco. We are really, really overwhelmed and humbled by the fact that there has been a 190 times of interest shown by the institutional investors and around 75 to 77 times in terms of the overall subscription for our IPO. And it is only with that hope that as a team we are working and trying our level best to work with commitments and passion to take the company forward. Even in the industry itself, we can see that in the future, the coming 10 to 15 years, we are extremely optimistic. The way things are moving, there will be growth for India, and along with growth for the country, there will be demand for jewelry as a category. Now, in terms of the number of showrooms that we have been able to open in quarter one, we have opened total number of 6 stores, out of which 5 have been company-owned, company-operated, and 1 have been franchisee. And as a result, our number of stores have moved up above 140. The new geographies that we have entered in the first quarter is Sikkim and Gangtok, to be more specific. And we can say that as a part of the organized sector, we are the first jewelry retail player to have opened our store in Gangtok. We have also entered the MP market with our foray into the central India, if we may say. Also, in terms of number of stores, in terms of franchise, which has been one important milestone for us as a company is that this has been our first franchisee into Bihar. While we have franchisees in Jharkhand, we had always company-on-company operated stores in Bihar and Patna, but we have opened our franchisee store in Bhagalpur. It opens up the opportunity to open more and more stores in Bihar as a part of the strategy. And in terms of the pipeline of the new stores that we intend to open over the next quarter, we have 8 in the pipeline, out of which namely there are stores in Chandigarh, one in Calcutta, one in Delhi, one in Bangalore, and one in Pune. Now, let me get into a little bit of the numbers. During the quarter, we have seen that in terms of the quarter one of the previous financial year to quarter one of this financial year, there has been a growth of 29%. And if you look at the price of gold that was there in quarter one of the previous financial year to the quarter one of this financial year, as per our estimate and calculation, it was on an average 5,100 per gram in the previous year's quarter to 5,900 per gram in this year's quarter one. In addition, we've also achieved a volume growth of 8% from 1,400 kgs to 1,600 kgs. Incidentally, we also achieved an increase in stud ratio, as I mentioned, from 9.6% to 10.8 to 11% kind of a growth, which is mainly driven by our growth and the sales that we've had in North India. Where in Delhi NCR region, we have seen a stud ratio of 18 to 20%. So this is where we would like to continue to focus our growth, as we have already mentioned before, in the eastern and northern part of the country, with 2 strategic imperatives. One is to continue to leverage our brand and goodwill in eastern India, and to build the brand more and more in northern part of the country. It will also help us with our diamond jewelry sales and growth. So the value of growth in silver and platinum also has been around 15% and 17% respectively. The volume has been 7% in silver and 9% in platinum. And if you look at like for like or same store sales growth, the overall growth, it has been 21%. So that is the kind of same store sales growth that we have seen from our existing stores. When we talk about our digital business, it is not only the direct sales that we do through our websites. We have seen that there have been issues in which the consumers are looking at our website. They are looking into the designs that we are putting up on the website, and then taking a call, decisions, leads are being generated, going to the stores and buying a jewelry. And as per our estimates, we have seen that around 12% of the business that we have garnered has been digitally led. So in the overall growth, we can see that the franchisee business has grown by 18%, while our overall own stores have grown by a higher percentage. Now, one thing that is there is the number of customers. So we have at our monthly installment scheme, the Swarna Yojana as we call it. Our customer base in Swarna Yojana is around 80,000, and the total outstanding that we have from the customers, the kind of deposits that we have garnered from them, is 200 crores in the last quarter. And as I have already mentioned, the HUID program that was initiated by the government has been a major role in which we have seen a large number of customers paying for old gold exchange. And the purchase of jewelry by customers from old gold exchange has increased. And the customers have also increased to 24% from 19% last year out of the total purchase of 1.8 tons of gold that we have seen. And this includes around 50% customers who have been first time. So that is where I think the shift of the unorganized to organized players has been happening, in which new customers who have not been buying from Senco but the unorganized players are now planning to buy from branded players, adding to the customer base of Senco. In terms of the ATV and ASP, we have seen that has also grown by 20% or so. And the new buyer contribution has been around 45 to 50%. With the repeat footfall of customers, the loyal customers that continues to come and buy has also gone up from 68,000 to 86,000. And in terms of the number of pieces of jewelry that we have sold 2,88,000 pieces of jewelry to over 1,89,000 customers, increasing around 8% year on year. This has been certain of the success and achievement of Senco in the first quarter, and we look forward to continue to perform, continue to reach out to our customers, strategize and build new initiatives so that customers keep coming to us. In terms of production and new designs that we have created in the quarter one, we have added about 9,000 designs in gold jewelry and 6,000 designs in diamond jewelry. Along with that, there have been initiatives taken by the IT department in terms of ensuring that the ISO certification 27001 is confirmed. The Cisco networking, connecting all the stores, ensuring that the data and the internet speed and connectivity happens truly, and the ERP that we are implemented of Microsoft and the CRM, there should not be any kind of network issues, and that is why we implemented the same. So this has been an overall success and achievement of the company in quarter one, along with the great success of IPO and all the support that all of you have given. And we would like to continue with that same energy and vigor quarter two and the year forward. Now I will request Mr. Banka to take you through certain numbers and certain areas of our business.
Thank you very much. So as briefed by our MD about the business performance, the performance has translated into a good financial performance. So the revenue have increased by 29% to 1,304 crores in quarter one, and this was the highest ever quarter with this revenue. The benefits have also flown at the EBITDA level margin. So margins have improved by 27% from 67 crore to 69.91 crore. And the PAT has improved by 22% from 22.55 crores to 27.67 crores on a consolidated basis. Now this clearly shows that we are doing our cost and expenses in a proper manner. We are also very happy to announce that post the IPO, as our net worth has increased, our debt equity ratio has become below 1. So before IPO it was in the range of 1.2x, and now it is 0.84x. And we will continue to leverage our balance sheets very efficiently, and capital allocation for the new store will be done in line with our business plan. Our inventory, which has come down during quarter one on account of post the festive season, now again we will be building up our inventory as we are readying ourselves for the next quarter. The borrowing, the blended rate of borrowing, as we had explained during the pre-IPO period, the blended rate of borrowing is around 6%, and on the gold metal loan we pay around 3 to 3.5%. So this efficient interest rate, it gives us a superior return on net worth, which is in the range of 20%, and we will continue to work on this line. So with that, we open the house for Q&A session, and we would really be delighted to answer to your queries and share our future plans with you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devanshu Bansal from MK Global Financial Services. Please go ahead.
Hi, thanks for the opportunity and congratulations for a very strong set of numbers as well as on your first call after IPO. Sir, I wanted to better understand this 30% growth number that you have delivered in Q1. Is this the rate that we expect to continue going into coming quarters as well, or there is some extent of preponement of some of the phases that would have happened in the coming quarters? So, first question is on that.
So Devanshu, if you look at the historical numbers, I'm sure that all of us are trying to analyze that how the year will going to be like, right? So if you look at historical numbers, the growth for Senco as a company has always been in the range of, I would say, on a conservative approach, in the range of 15 to 20%. This particular quarter one is a quarter of Akshay Tritiya, and that is the summer wedding season. Then we have a quarter two where there are no such wedding seasons that would be there. But again, last year also we have always seen that the H1 of a particular financial year has a business of about 40 to 45%, while the H2 of the financial year has a business of 55 to 60%. So our endeavor to continue to perform like the way we have been doing in the past will continue to remain. But at the same time, every quarter is important. Every quarter needs its own strategy, and we will closely observe and keep sharing the information with all of you as and when the quarter crosses in terms of our performance. But like the past, the range and the target of 15 to 20% growth, this is going to be our endeavor and our effort to move towards those numbers.
Got it, sir. Sir, typically between Q1 and Q2, what is the kind of seasonality, as in how much is Q2 lower versus Q1?
Q2 is not lower. Q2 is lower by, if you look at Q2 is lower by approximately 10%. So that is what we have seen the seasonality between Q1 and Q2. So we could, do some kind of an analysis accordingly. But at the same time, though we would not want to give, this is our first time post-listing that we are all in discussions with all of you. The performance, the numbers, the month of July, and we are in the middle of August. The customer response, the retail response has been good, and we are looking at, compared to last year, the numbers are better. So this is how we would look at it.
Got it, sir. Sir, we have given a very strong performance on the studded mix side. I wanted to understand this margin decline. So what was the reason for that? Is it largely because of higher mix of gold exchange, or how should we see? Because we have seen a very strong improvement in our studded mix.
So Devanshu, as you said, jewelry industry, the structure of gross margin is not same in all the 4 quarters. So even in quarter one last year, the EBITDA margin was 5.5%. Obviously, EBITDA margin is a sub-product of gross margin. So it clearly is dependent upon the stud ratio, the franchisee sale. So last year our franchisee growth was slightly lesser, single digit, and we are very happy to say that this year franchisee growth has been more than 20%. So a higher franchisee sale will result into slightly lower gross margin, a higher return on net worth. So that is one. And similarly, the old gold, which was 25%, this quarter we have seen a very high input of old gold, not only from Senco customers, but from non-Senco customers. So this has played their relative impact. Price change, gold price change also plays a small impact. But overall, we look at the EBITDA margin at the same range which has been there last 2-3 years, in the range of 7 to 8%. Quarter one is just indicator, but not a full year. So we must say that the full year performance should be just in line with the past trend. For example, in last year, our PAT in H1 was around 30 to 40 crores, and in H2 it was almost 130 crores. So we expect a similar trend, and you would see more when the quarter three results come into public domain.
Mr. Banga, what is the growth that you called out for franchises? Is this higher than the overall growth of 30%, is what you are saying?
Sorry?
franchisee growth in this quarter is higher than the overall company growth of 30%?
Franchisee growth was slightly, I said franchisee growth is in 20% range, 22% approximately, around 18%, whereas the own channel grew by 29%. So own channel 29%, franchisee 18%, which was less than 10% last year. So overall 29%.
Sorry to interrupt. Mr. Devanshu Bansal, may we request you to join the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you, sir. Our next question is from the line of Drisha Podar from Carnelian Capital. Please go ahead. Ms. Podar, your line has been unmuted. Please go ahead with your question.
Yeah, hello. Am I audible now?
Yes, ma'am. Please go ahead.
Thanks for the opportunity. Just wanted to understand, continuing from the previous participant's question, that, this 29%, the strong growth that we've seen, how much of this would have come purely from just bullion sales?
The bullion sales will not be too much. See, bullion sale in our case, Rita, we are basically gold coins which are not more than 2 to 3%. So if you look at a 4,000 crore turnover, I think it is less than 1%, not even 40 crores. Our main business is jewelry business, coins, etc. We don't really focus because there the gross margin is lesser. So we focus on a high margin yielding products as our strategy.
I rather, Trisha, to add on and give more explanation, we've had an export sale close to 45 to 50 crore, which is again a very low margin kind of a channel. So if you can say that rather than on the bullion sale, out of the growth we have seen a sales growth of exports, which does not add to the gross margins to that extent. So this is how you need to look at it. Say for example, just to give you all an idea, till say the YTD, we've had an export sale of 77 crores, right? YTD. The previous year, the similar time, our export sales was around 19 crores. So that's like 50 crores of 55 crores of extra sale, which does not have a high gross margin. So this is where you could say that, why overall the margin has not been looking that great.
Okay, and so what has led to this sudden, such a high growth in exports?
See, what has led is that there has always been a market for jewelry export, and there are customers all over. We have seen that gradually. Most of our exports happens in Middle East, a little bit in Singapore, and demand from the customers worldwide has always been there, and we are also putting our efforts. I'm a member of the Gem and Jewelry Export Promotion Council. So we are reaching out to new customers, taking orders. Overall, in the whole scheme of things, say 50-60 crores in the overall sale of more than 1,000 crores is 2 to 3% only. But that's what it is. The numbers, the growth looks high, but in absolute terms, the numbers are lower. But there is a demand for jewelry that is happening. And one more thing we can say and see is that as an organized player, the availability of capital, the ability to execute orders of customers worldwide is also becoming a capability for us compared to the unorganized players who are unable to keep up of execution of orders. So this is how I think the two factors that are playing us for us to grow our exports. So in the overall scheme of things, it still remains to be in the range of 3 to 4% of the total sales.
Understood. Thanks. I'll join the queue again if I want. Thank you so much.
Thanks, Rita.
Thank you. Our next question is from the line of Aegis Lakani from Unifi Capital. Please go ahead, sir.
Yeah, hi team. Congratulations for the results. Swakar, I have a couple of questions. First is, could you just explain us, this is your first meeting call, so how is the hedging policy at the company's end? Are you always 100% hedged or is there some component of the price of gold prices, like the mark-to-market prices, which also sit in the gains? Could you explain that entire piece for us?
Right. So see, our hedging, if you remember, happens in 2 to 3 ways. One is the metal gold loan that we take from the bank, the unfixed metal gold loan. So that is a system of auto hedging. The second is the position we take on MCX in terms of future sales or options. These are the methods of hedging that we do. And as per the policy, we always remain hedged, majoritarily. More than 50% is what the policy says. But over the years, we have always stayed hedged above 80%. So this has been the kind of hedging procedures that we have been following. And in the same manner, in Q1, we have followed, and the hedging has been above 80%. So this is what it is.
So, is it fair to say that, some amount of margin benefit which is there in FY23 is on...
Mr. Lakhani, sorry to interrupt. May we request you to use your handset, please, as the audio is not clear, sir.
Is this better? Hello?
Hello? Yes, sir.
Is it better?
Sir, yes. You can go ahead, sir.
Thanks. Is it fair to then assess that the margins in 23 would have some amount of mark-to-market benefits of the gold price increase sitting in the gross margins?
Let me take this question. See, this is basically, as you said, that we are 80 to 90% sales, right? So which means that effectively we don't make any gain or loss in case of price rise or price fall. Now, the gains or losses which are there, they're unrealized gain. So let's say even in quarter one, as the gold price moves, there are unrealized gains. Now, unrealized gains will not move into the gross margin. But what you should see is that over 2 to 3 quarters, when the realization happens, the impact will be there. Now, to answer to your specific question, yes, last year partly, part of the gross margin was on account of accounting gain which moved through the gross margin, and that's why in the current year we are expecting slightly lower gross margin as we look into the new markets and as we look at intensifying customer interest and to pull new customer interest in the market.
Got it. So, my second question is that you had a successful franchisee set up for 15 years running. So I want to really understand that what makes franchisees stick with Senco. Today, a lot of the players are trying to go the franchisee route, and you have the leading national player as well as other aspirants also offering franchisees. So what makes the franchisees stick with Senco? Is it lower upfront fees? Is it better support? Could you speak a little bit about the same?
So Ajay, I'll try to be without really disclosing too much, which might be sensitive to information for the strategy of the company. But all we can say that Senco has always been known for products which are affordable and lightweight. That is our USP. Coming from Calcutta, which is the hub of jewelry creation and manufacturing, working directly with the karigars, we create jewelry within the ticket size or budget of the customer, middle class and upper middle class customer of the country. So we have always been addressing the big base of customers, the broad, big fat middle class. And at the same time, our focus for our franchisee business has been the tier 2, 3, 4 cities of the country, in which the customer has certain limitation of budget. We have been able to provide designs as per their taste and preferences. So these are the 2-3 reasons. Other than that, I'm sure that any good organization or company that is trying to get into the franchising business, many of them are successfully running it as well. But the bond, the relationship, we treat them as family. So these are all very soft and subjective matters, but the real would be in terms of the product that we create, which is as per the taste of the upper middle class and as per within their budget. I have always been saying that our average ticket size has been in the range of 60 to 70,000 rupees that we sell to the customers, and that is what I think that everyone and anyone can afford. So that has been a benefit, I can say.
Got it. And finally, just in the old stores, your sales from existing stores and new stores, could you quantify the sales per store on an average?
That is, Ajay, that's what we are saying, that the LFL growth this year has been 21%. So the existing store growth has improved. In fact, if you look at trailing 12 months, I'm giving you the breakup. The trailing 12 months, last year first quarter we had got 131 stores, 142 stores. Almost 11 new stores have come up across India, which have come in West Bengal, total east and northeast 7, north 1, west 2 and south 1. Now if you look at growth across the various geography, the highest growth we have received in west to the extent of 56%, because the stores numbers are small and so on. So last year franchisee had grown sub 10%, and this year franchisee have grown 15%. So with this growth in franchisee, clearly the tier 2 and tier 3 towns, which we are facing some post-COVID difficulty, I think they are out of those challenges, and we are likely to see a higher growth in the rest of the year, and particularly as we are building up our inventory for the festive season.
So that's noted. Could you just call out what is your revenue per store, existing and new?
Revenue per store, existing and new.
See the new store, as you said,
which are still been in the system for, but the new stores stay with the track record, stay 1.5 years. What is being there, the average revenue there and the existing store revenues?
So Ajesh, if you look at the overall turnover as on 31st March of 4,000 crore, with a number of stores of 137, so our average sale has been in the range of 35 crore, right? And when there are stores which does above 50, 60, 70 crores, and there are stores that does below 30 crores as well. So anyway, it takes about 2 to 3 years. Going store by store, it might not be possible for us to share that information over the call, but we'll be happy to explain and take you through the model anytime in the future.
Got it. And just finally, Suvankar, that the studded share used to be in the mid-single digits up till a couple of years back, and now some stores your press release states is doing 15-20%. So what's been, and at a blended level even you're at 11%, which is quite respectable. So I wanted to understand that in the last 3-4 years, where is this sudden shift? Is it a function of something internally that is being done by Senco, or is it a function of the external environment?
Oh, so there are anywhere to achieve a strategy, you need to have multiple plans in place. So one is in terms of design development. Two is in terms of two is like to train the team, to motivate them towards serving the customers better. Third is that overall, if you look at it, the psychographics, the fashion, the lifestyle of the consumer, so there is an inherent demand for diamond jewelry that has also been on an uptrend. Fourth is that the young consumer also, if you look at it, the ones who are now going cross buying, the kind of clothes that they are wearing, the occasions that they are visiting. So jewelry has, while modern Western designs of gold jewelry are being produced, but at the same time the of diamond jewelry are more Western and modern. So these are the 4 factors, and we have, on those factors, we've understood the factors, and we are ensuring that we are keeping the right product for the customers. So this is what I think would have helped us to achieve the growth.
See, as you are asking, moreover, we have invested in the team for the diamond. We have invested in the inventory, and as you see, our diamond sale has almost doubled during the period 2017 to 2022. Last year, 2023, the diamond jewelry sale increased by 30%. And in the current year, if you look at YOY, The current year, the diamond jewelry sale has increased by almost 50% with almost a high concentration across all areas. And in certain market, as you said, the stud ratio, and even in the press release we said, while our blended stud ratio, which is at 11% currently, which is around 14-15% in the own store and around 7-8% in the franchisee, that is growing across the franchisee also. And in some of the geography, let's say NCR, in Delhi, it is in the range of 15-20%. So we are committed to increase our stud ratio, as it is a very important driver for the top line as well as the bottom line.
If you look at it, that is that we have a sub-brand called Everlight, which is lightweight jewelry, where most of it is diamond and platinum jewelry. And if you happen to visit our website, you will see that we are continuously coming up with new designs and innovation under that brand and collection, right? We also have a brand called Perfect Love, where we are selling hearts and arrows cut diamonds, in the solitaire, but not the 1 carat solitaires, but the lower size, the pointers, we call it mini solitaires, for the consumers to buy. So therefore, we are continuously working hard on the design. Our design team is working, our merchandising team is working. And I think all put together, it is showing the results.
Thank you. Mr. Aegis Lakhani, may we request you to rejoin the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. If you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Srinidhi from Pioneer Wealth Management. Please go ahead.
Hello. Hello.
Yes, sir, please go ahead.
Yeah, sir. Congratulations for the great set of numbers.
Thank you.
Sir, I just wanted to understand that what is our thought process of basically taking the advantages, when we sell to franchisee, we don't take royalty, but instead we charge margin on it. So just wanted to understand that why do we, follow that model? Like, what is the pros against those by charging royalty?
By charging royalty or by charging margin on it?
What was the thought process? We are charging margin instead of charging royalty. That is what I wanted to understand.
No, it depends. Actually, see, the franchisee is buying the stock from you, which is their investment, right? So, in a way, we are creating jewelers, people who are aspiring that their sons, their children, their family members also be a part of the respectable industry of jewelry and keep themselves productively occupied. So we are saying, fine, if you have to put your skin in the game, you invest in the stock, you learn the business, and that is how we drive forward. And we are always there at the back end to support. So that is the benefit, that there is a sense of ownership by the potential franchisee. When it comes to royalty, it's my understanding, it is whose investment. If it is their investment, then I don't know how the whole process of royalty will work, because ultimately it is going to be a percentage of sales that as a company and as a brand we will be able to charge them. But when we know that, fine, I am investing it and I will earn out of it, the company is helping me at the back end and supporting me, so I'm keeping my margin and selling it to them. So my risk, I am keeping a minimum reward and passing on maximum reward to them, while in terms of the risk taking, they are taking a little bit of a higher risk, but at the same time they are getting rewarded more. I think this is the pros and cons for this particular model.
And so what will be the working capital days like from the franchisee?
Yeah, franchisee basically does inventory. In the first year it has two rounds, second year 3 rounds, and after that. So by that logic, inventory days, it will be, in the first year it will be 180 days, and third year it will be 150 days.
These are all average numbers.
And most of this inventory depends upon the product mix, because for diamond the inventory days are higher. So it varies from a geography to geography and business model to business model. So exactly if we compare one company inventory turnover ratio with the other, it will not be comparable. The best indicator is to compare is the return on equity. I think that is the solid most indicator across that we can compare all the companies.
No, I just wanted to know that inventory will be in their books, right? If my understanding is right.
Yes. So we call it asset-light model. We sell them inventory upfront, and as against a normal gross margin, we retain some and we leave 13%-15% for them. So inventory belongs to them, inventory in their books, and we recognize the revenue the moment we sell it to them.
So I wanted to understand the data. Basically, like when we sell the product, how many days like we get the money from them?
There is no data days. We sell them upfront. In many cases, they give advance. Only during festival days, let's say during Akshaya Tritiya or during Dhanteras, a short-term period of, let's say, 15-20 days, we give them a short-term, that's all, for maximum 30 days. Right.
Okay, so there is an upfront model, advance basically we take from them.
So whatever data you see as on 31st March, almost 50% to 60% of that is pertaining to the franchisee. And a similar number comes in September, that's all, twice a year.
Okay, sir. And so then the last question will be on the working capital side. Like, since last year we had a negative, like cash, we didn't any cash flow from operations. And again, I guess even then the last 2 years, we have been unable to do that. So like, is there any strategy, where how we can optimize our working capital days and just free cash flow from operations?
Right. So, as you explained earlier, it is an optical illusion. So the different companies have been adopting different modes of reporting the operational cash flow. So you see that in our case, the gold metal loan is shown as a financing activity. So we did not change our accounting disclosure in March 22 and March 23. The moment we adopt the industry standard and move it to part of operating cash flow, you will see operating cash flow optically positive. And in reality also, let's say, if you look at the PAT of last year, 160 crores, the 50-40 crores depreciation, 200 crores is the free cash flow in our company. Now, using that for the existing stores and for capex, balancing entire free cash flow. So the gold business is a high free cash flow business. So the free cash for expansion and for new stores. That's why what you are seeing is an optical negative cash flow. But the business is one of the most robust and most liquid balance sheet, and free cash flows are quite high.
Okay, sir. And sir, we have a strong brand recall in the eastern side, where we have a strong brand recall and we have a strong foothold. So just wanted to understand now from that side, where we are expecting the growth. Is it from the new stores are we going to open, or new products, or from existing stores that we can see a good footfalls over there? And since we have a good brand at east, but we are also moving towards north, so that also we have to build our brand position. Any strategies how we are going to build it and scale up that area of the business?
Well, our focus has been east and northern part of the country, right? And we will continue to leverage the goodwill, penetrate into the tier 2, 3, 4 cities of East India, and also build the brand in northern part of the country. So this has been one of the broad strategy, and we will have a very focused approach towards the same. If you look at the same store sales growth also, which is helping us in terms of growth, we have grown in the Q1 by almost 20-21%. So just imagine that even with stores that have been existing over a longer period of time, thanks to the shift of the consumer preference towards brand and new products, we are getting new customers in the existing stores also. So overall, the growth will happen in 3 ways. New geographies, having your new customers in your existing store and the new stores, and you continue to create new products and designs, and then you will have your existing customers who would be, we build that strong relationship, and they'll keep coming back to you to buy those new products. So I think these are the 3 ways we look at the growth to happen.
Sorry to interrupt. Mr. Srinidhi, may we request you to rejoin the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Our next question is from the line of Priyanka Trivedi from Antique Stock Broking Limited. Please go ahead.
Yeah, so thank you for the opportunity and congratulations on the good set of numbers. So my question is, we've mentioned that we have witnessed higher traction in the northern region versus the eastern region. So could you give us a sense on, what has the growth been in each of these regions and what has been the contribution to sales of these regions?
Yeah. See, Priyanka, growth, as you said, is 29%, right? And 29% growth has come from own store 29%, franchisee 18%, and others small one, different one. So when we look at the zone-wise growth, YOY versus last year, so last year first quarter revenue was around 1,017 crore, this is 1,314 crore. So highest growth has happened in West, that is 56%, because the base is low. So you can say 23% in West Bengal, 31% in East, which includes West Bengal, North East, Bihar, Assam and Odisha. And then North was around 24%. So that is the range. So almost the entire India, the entire Bharat is growing. Good thing is that tier 2 and tier 3 towns, which were at a lesser growth last year, they are also growing in the range of 18%.
Okay, so got it. So my second question is, further diving into our 29% growth, could you give us a sense on, which, in terms of the ticket size, how the growth has been like between below 5,000 range, 50,000 range, 50,000 to 1 lakh range, and above 1 lakh range, how the growth has been, where the traction has been higher?
So, Priyanka, we don't have those exact breakup details, but what we have told already is that in terms of average ticket value, that has gone up from 55,000 to 66,000. This is the kind of increase we have seen in terms of the purchasing ticket value of the customer. So now whether just to add here, what we saw that our ticket size in the three category up to 20,000, 20 to 50 and greater than 50. Structurally, it has remained the same for the 3 years. So while we will give down and by the next call we will come back to you with more details, but we are expecting that the growth will be more or less similar. The structure has not changed in our case in last 3 years, so the same will remain in this quarter also.
Okay, sir. Got it. So, and lastly, on the outlook for the coming quarter, there has been an inauspicious period of Adhik Maas and, lower number of wedding dates also versus last year. So, how has the overall outlook been for the quarter, for the coming quarter?
You're talking of Q2, as in what is quarter that is on?
Correct, yes, Q2.
Priyanka, if you look at quarter 2 of 21-22, we clocked a turnover around 900 crore. And even in 22-23, we clocked a turnover of 900 crore versus 1,007 crore in quarter 1. So while we have seen a good growth, 29% growth, even as of now, 1.5 months is still pending to be achieved. And when we are saying that we will achieve a growth for the whole year in the range of 15 to 20%, we expect that in quarter 2 also will give us a good growth while we are readying ourselves for the main festive season, that is quarter 3. So you can expect upwards of 1,000 in quarter 2.
Thank you. Ms. Priyanka Trivedi, may we request you to rejoin the question queue for follow-up questions. Thank you. Ladies and gentlemen, a request to all participants. Going forward, we would be taking one question per participant. Thank you. The next question is from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir, and thank you so much for taking my question. So firstly, congratulations on a great set of results. Hello, am I audible?
Yes, you're audible. Yes, thank you.
Yeah. So, sir, I just wanted to ask, we've grown splendidly in this quarter. Are we being a bit more conservative by saying around, 15 to 20%? Because if the reverse calculated which one is supposed to be 45%, then the good chance we might end up going more than 5,500 crores. So are we being conservative?
I'll tell you what, Q1 we've had a splendid performance. Q3, the base for all jewelry companies is on the higher side. So we rather, this is what we believe, that we rather be conservative and achieve our numbers rather than unnecessarily have a extrapolation and a high expectation in the way it would be. So it is good to be conservative and that approach, I think, in the long run, as we finish every quarter, we'll keep updating you, but this is what we would want to move ahead like.
Thank you. Mr. Javed, may we request you to rejoin the queue for follow-up questions. Our next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead, sir.
Yeah, thanks for the opportunity. So, in the case of franchisee, how does the hedging work for the franchises? Do we on behalf of the franchises inventory that gets sold to them, or they do it on their books?
Oh, sorry, the inventory is on their books, and see, for them, the inventory, the stock that they have, is a long-term asset. Just like you would invest in real estate, for them it is an investment of their capital in gold and diamonds. So they are not so, I would say, focused on hedging. They believe that gold as an asset will give them returns in the long run, and that is how they would ensure that as much as they are selling, they will keep buying. So it is on them. Depends on the franchisee whether they would want to hedge or not. We only guide them, but we leave it to them to take the decision.
Thank you. Mr. Ankit Gupta, may we request you to rejoin the queue, please. Ladies and gentlemen, in the interest of time and fairness to all participants, we may request participants to stick to one question per participant going forward. Thank you. Our next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, and congratulations for a good set of numbers. So my first question is that, if you look at the historical numbers, last 4 years we have grown at CAGR of 20% top line. Can you break it up in terms of how much of that is from SSSG and how much is from the new store expansion? And a corollary to that, if you look at gross margins, they're around 17.5 to 16.1, but the operational leverage has not played out. Our gross margin to EBITDA conversion has almost remained the same. So any sense on that, why the operating leverage scale growing out?
Anil, as I can part of your question I can hear. One is that you asked for the SSG, right? Same store sales growth.
So his question was that in the growth that we've had, how much of it was SSG and how much new store? The second part of his question was that the operating leverage has not started to act upon in terms of increasing of the gross margins and all with
Anil, I will say differently. As our number of franchisee, as the franchisee percentage increase, the gross margin will dilute, because in case of franchisee, we have a lesser gross margin in the range of 5 to 7%, whereas own store is slightly higher. So that's what we are saying, that don't look at gross margin or EBITDA margin, because all the jewelers have different business structure. So best would be to look at the return on net worth, where we are among the top 3 in India in March, in FY2022-23, 21-22, and even in the current quarter when we have seen the results of other players, we maintain among the top 3 slots in India.
And the SSSG versus new store, major of the growth comes from SSSG. The new stores, takes time for gestation, and maybe not on the first year, but on the second year they add to your growth numbers. But on an average, though we don't have the exact numbers currently, but all I can say is that 80% of your growth comes from SSSG, if I'm not mistaken.
Absolutely, sir. Yeah, because the new stores, let's say, there are 10 new stores, their turnover, let's say last year out of 4,000 crore will not be more than 200 crore. The majority part of growth will definitely come from the existing stores, because in our case, since the average sale per store has a huge scope for improvement. So we look at improving the productivity of the existing store, the total 142 store portfolio which we have.
Right.
Thank you. Mr. Desai, may we request you to rejoin the queue. We move to our next question. Our next question is from the line of Gaurav Gandhi from Glorytail Capital Management. Please go ahead.
Yes, thanks for the opportunity. Congratulations sir, on the good set of numbers and successful IPO. Sir, one major thing why people stick to the traditional, their known jeweler, is because of the lower making charges they charge. Right. So organized jeweler most of the times, have higher making charges than the traditional ones. And one of the things which can attract these customers to our showroom and pay higher making charges is by having beautiful and unique designs. So what are your thoughts about the designs which is in our showroom, and also whether our jewelry design matches with the community choices and according to the regions where we are present?
Right. So the designs that we are keeping in the store, our design team, our merchandising team is working hard, doing the research and creating a balanced merchandise. So there are certain designs which are unique to the origin from where we come from. And we are playing out with the percentage of how much we keep designs unique to our brand and designs which are as per the local taste and preferences. Maybe I'm not disclosing the exact balance of the percentage, but we are very conscious of the fact what you are saying, and we are working with our karigars and suppliers and vendors to fulfill that need. And as you are aware, that again, our head office being in the city of Calcutta, most of the designers, artists, they are from this part of the country. So we have the inherent capability and strength, and we are trying our best to work on those so that we could charge. See, the intention of charging a higher making charge is not that unfair to the customer, but the customer should get value against the money that they are paying, right? The value could be in terms of design, the value could be in terms of behavior, in terms of service, in terms of the brand that we build. So that is how I think any organized player in the country will have to think of and build that strong relationship with the customer.
Thank you. Mr. Gandhi, we request you to rejoin the queue, please. Thank you. The next question is from the line of Rahul Ranka from Social Investments. Please go ahead.
Good evening, sir. Am I audible?
Yeah, Rahul, you're audible.
Sir, I wanted to know what could be the guidance for volume growth in the coming years, sir. That's my first question.
In the coming years?
Yeah. In this current financial year, what volume growth are we looking for?
See, Rahul, if you look at the current quarter, the quarter one which we saw, in the quarter one, our volume growth was in the range of 8% for gold, and for diamond, 34%, for platinum, almost 50%, right? So, volume growth is clearly, as we are moving into the new territory, as our stores, particularly in the north, south and west, we get more traction, volume growth will happen. But as you see, the volume growth is also linked to prices. Ultimately, as a jeweler, our main focus is the top line. Now, whether that top line comes by value or volume, that is subsequent. So we have seen that when the gold prices rise, the volume comes down. But the jewelers achieve the growth target. So we would like to see from that perspective.
Yes, and if the price goes down, then again the volume goes up.
Yes.
Right. So our objective is to ensure that the share of the wallet of the customer in terms of money, that gets covered by us. So that is how we would like to look at it. If again, here we are all in the business of trying to understand how the future could be. So if the prices remain stable, I can assume that the way the volume growth we have seen in Q1, we would be able to see a similar single-digit, mid-single-digit kind of a growth. If the prices move up a little bit, then the volume growth might come lower, single digit, because we will add new stores and try our best to do something. If the price goes down, then maybe the customer will come out more, with enthusiasm and buy more. And we might have a high single digit, low double digit. But it all depends on the consumer liquidity availability with them and the price of the gold.
Thank you. We move to the next question. Our next question is from the line of Gustav from Das Investment Group. Please go ahead.
Hi. I just had one small question. So right now we are trying to increase the percentage of our studded share. So if you consider that maybe 4-5 years down the line you reach like 50 to 20% somewhere in the range of studded share, what would be your EBITDA margin, blended EBITDA margin for the whole consolidated company? What would be the EBITDA margin that you guys think you would be achieving?
Gustav, as we have seen that while due to increase in the stud ratio, the EBITDA margin will improve, but there will be other places the competition will increase, will be entering into new territories. So we look at EBITDA margin in the same range. We don't expect a dramatic increase in the percentage as such, but the volume, the absolute number of the EBITDA, the absolute volume in terms of rupee will increase. But percentage in terms of quality, whatever increase happens due to stud ratio, it may get diluted or impacted by the other market factors, on which obviously we'll try to work on as well.
Okay, got it. But I just have one follow-up question to that. So, wouldn't it be better if you try to drive more of your business from your own stores? And clearly, you have grown your own stores and much more, I think, couple of percentage points at least higher than your franchisee stores. So, don't you think on that regard, you could add to your EBITDA margin because the EBITDA in your franchisee store is lesser, but in EBITDA in your own store is higher. So if your own store business is rising faster than the franchisee store, shouldn't that actually not dilute that to EBITDA margin?
So Rahul, there are 2-3 things that you need to keep in mind. One is EBITDA, one is return on capital or return on equity. So it's all about balance. In when you have enough and more capital to keep on opening your own stores, yes, it makes sense. But how do you leverage your goodwill? How you leverage your brand? How do you penetrate into the smaller towns? Then you would need the support of a model like franchisee, where they will also invest, and you're sharing your EBITDA and all of that. But at the same time, you're being able to reach to customers using not your capital, but sharing that growth and profitability with other people. So it's all about balance at the end of the day. Someone will say open more franchisees. You're not using your capital, but you're using your goodwill. Someone will say open more stores. So we need to balance it out. That's all I can say to your answer.
Thank you. We move to the next question. Our next question is from the line of Deepak Saha from Soboda Infinity Investment Advisors Private Limited. Please go ahead.
Thanks for taking my question and congratulations on good results. I have only one question. If you look at your store distribution in West, especially East region and West Bengal, you are far entrenched with Tier 2 and Tier 3 districts. You have presence there. Now, when you are coming to East to North or other parts of the country, do you think first of all you should in the same way expand with districts and geographic presence that you have? Secondly, given East has a lot of relatively lower per capita, do you think if you do your positioning a little bit different from the current one, specifically in terms of securing faster growth, because North and other parts has relatively higher per capita with respect to that's all from my share some color.
Your voice was not totally audible. Can someone explain the question?
Okay, so can I try one thing? Is it better now?
Not very clear.
So if you can be slightly slow.
Or
See, what I could understand is that you are saying that what will be your gross margin as you move to tier 2 and tier 3. Is it what you are saying? The margins movement as we move to tier 2 and tier 3, and you are assuming that the market in tier metro has matured. Is it what is query?
No, my specific query is strategy that you have deployed in West Bengal especially, where you have more number of stores. Do you think same district level presence, you have lot of the stores are district level capitals. So same level of presence will help you in north in terms of securing faster expansion. Second thing, if you see in West Bengal or in east, the GDP compared to other parts of the country will be lower. So you position yourself in terms of different on the north side, right? Given that GDP is on the higher side, do you think the kind of growth you can secure compared to east will be much more faster in north?
Right. Okay. So the first thing is, yes, our whole focus is that in the bigger cities, we open our company-owned, company-operated stores. We build the brand and look for potential franchisee partners in the smaller towns. So the way we have done it in eastern part of the country, we would like to follow a similar pattern in northern part. So that is what given us success, and we would like to replicate the same. And on the answer to the positioning of our brand for northern India, if you see that we have been trying with our brand ambassadors, like Kiara Advani, the products and designs that we are developing for North India is as per their taste and preferences. So, and our average ticket size, though we don't have the exact data, but all I can say is that the average ticket size in North India for us is higher than the average ticket size in Eastern India, which is because of the higher per capita and which is there in the country. So we are conscious of the fact, and step by step we are taking the necessary action to achieve the growth and the perception in that part of the country.
Thank you. Our next question is from the line of Gaurav Gandhi from Glory Tail Capital Management. Please go ahead, sir.
Yes, thanks for the follow-up. Just one question. What can be the risk associated with the gold SIP scheme we run? And also, how does it add to the income of the company, if any?
So the gold scheme that we run, we call it Swarna Yojana, 6 months, 11 months, 18 months. We are guided by the Companies Act, and the money that you can raise from the customer is a percentage of your company's net worth. So this is the rules that we follow, and we are having a strong tracking and monitoring system to ensure that when we are raising the money, we are taking the necessary KYC and following the rules that are set by the government. So inherently, there is no risk if you are, putting your effort to ensure that all the necessary compliances are being done.
Gaurav, if I can understand your query, we are not committing the rates. So the customer is only giving the money, let's say 1,000 rupees over 6 installments, 6,000 rupees. So whatever is the gold rate on the date, on the final date that we are giving. So there is no
price risk.
There is no price risk to us in respect of
so your price risk is mitigated, your compliance risk is mitigated, and it allows the customer to plan their purchase and keep buying. Operationally, we are trying to ensure that the customer need not always come to the store. They can make digital payments towards the scheme as well. So I guess, we have collected 200 crores, and we have seen that 7 to 8% of our turnover in the business is derived from the customers who are enrolled in the scheme. So this is how it is. It's a great way to ensure that the Indian consumers can plan their purchases. So that's how it is. If it is done in the correct manner, it is a great thing to do.
Thank you. Ladies and gentlemen, this was the last question of our question and answer session. I would now hand the conference over to management for closing comments.
So yes, we would like to thank all the investors for showing interest in our company. As we have said, we have consistently delivered growth in terms of top line and bottom line. If you look at our financial performance in last 4 or 5 years, our CAGR growth has been amongst the best. Not only on the financial parameters, if we pick up non-financial parameters, which are equally important for a sustainable growth, our credit rating has improved from A- to A by the ICRA. Our governance norms, we are constantly upgrading. We have got Walker Chandiok as our statutory auditor. We have strong controls over our inventory. Our inventory goes through multiple layers of audit and verification by our own team, by the statutory auditor, by the internal auditor, by the bank ASM auditor. Similarly, our diamond inventory that is valued by a reputed third party valuer on every quarter. If you look at our commitment to ESG, if you look at our gender ratio, it is above 30%. So it shows the empowerment to female which we have there. We also look at empowering our Divyang people, and we give them employment in our back office. So overall, we look at factors like a social value creation. We look at trust of the customers and obviously delivering superior performance. This being the first quarter, we will continue to work with full passion and energy to meet the expectation of our stakeholders, of the regulators, of the society at large. That is from my side. I will give a concluding remark.
No, I just want to thank all of you. Post-listing, this is our first earnings call, and we have tried our level best to address your queries, and within the constraints and limitation of sharing our numbers or sharing our strategy, we tried our level best to address your queries, and we hope to continue to have this close conversation and close discussions within all of us, so that we can keep you updated on these numbers, on the performance, and the way we have built on trust and transparency with our customers. We would like to continue and the same philosophy and build the trust and transparency with our investors also. So that is from my side.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.